For many Indians, one asset class that has always been close to their heart is gold. Whether it's for jewelry or as a store of value, buying gold has for long been a cultural tradition, and the precious metal delivered massive returns in 2025. As global geopolitical tensions continued and trade related uncertainties rose following the imposition of steep tariffs on imports from many countries by the US administration, gold prices surged on growing demand. Gold exchange traded funds saw massive inflows, and major central banks around the world also have been accumulating gold. In recent days, the safe haven asset has touched new record highs nearing 1,39,000 rupees per 10 gram. In international market, gold has topped $4,500 an ounce. The massive 70% plus rally in gold in 2025 has outperformed equities significantly. The BSE Sensex has delivered year-to-date returns of just close to 8%. Thanks to this year's surge, the precious metal now has outperformed equities over a long 25-year period too. Gold has given average annual returns of over 14% since the 1999-2000 financial year, when it was around 4,400 per 10 gram, shows RBI data. In comparison, the BSE Sensex has delivered around 12% average returns over the same period. Will gold continue to shine in 2026? Well, trade-related uncertainties continue. Interest rates have also been coming down in major markets, including the US. That tends to augur well for precious metals. The All India Gem and Jewelry Domestic Council believes the uncertain global environment, expectations of rate cuts, dollar weakness, and central bank buying will continue to drive gold into a strong bullish trend. While volatility may increase, the overall outlook remains positive for 2026, its officials felt. Analysts at Axis Mutual Fund too pointed that many of the drivers that fuel gold's rally in 2025 may continue to provide support in 2026. But investors need to be mindful of potential headwinds that may temper the momentum they noted. High real yields, a stronger US dollar, higher global growth, reduced inflationary pressures, and a hawkish US policy stance may erode demand. Furthermore, profit taking, weaker ETF inflows, commodity rotation into industrial metals, and easing geopolitical risks could also weigh on the prices next year. One must also note that gold bull phases oftentimes are followed by long flat or even negative periods. If you look at historical data, for instance, gold price stagnated for several years post 2013. Gold serves as an effective diversifier, and therefore, from an asset allocation standpoint, it should be an integral part of an investor's diverse portfolio, experts note.